Hey Trader Stephen here. It's Thursday morning, November the 8th. I had a nice day in the market yesterday, so we're going to talk about that. Got a lot to cover. We're going to look at the individual indices and where I think the overhead resistance might be. I do still think that we have some work before we are, signaling a long-term uptrend. We could just be kind of in a correction rally type mode, which is where I think we're at. Of course, I could be wrong, but we're going to look at all the evidence. We're going to look at, what sectors are standing out. So I think that's important to pay attention to. Let's start with the S&P 500, and this is a very long-term chart going back all the way to 2009. And I remember saying up here that the market could pull back and it still has a long way to go to touch this 9-year trend line, which it has. Every correction, it has touched this trend line, and it did. We did get a weekly reversal on the major indices last week, and they are popping a little bit this week. So showing for a potential rally. Hopefully the rally holds. We're going to keep our eye on that, but I just think it's important to say that the market did come down and touch this 9-year trend line. I do think there is a little bit more whipsaw to be had in this correction, but that doesn't mean we can't rally for a couple weeks. But we'll just kind of have to wait and see and really take it day by day. We're going to look at, so I think this right here is a positive sign. But I would like to see that blue line, that 10-week moving average, to start curling up. If we look at the individual S&P 500 chart, and let me add the simple 50-day moving average to this chart real quick, just so we can see where I think the potential resistance could be. Is it's right here. So the market finally punched through some overhead resistance yesterday. Big day. I do think it could spend the next couple of days kind of settling down, and then we'll see where we're at. But the market did punch through the 20-day, punch through the 200-day, and I see some overhead resistance at this curling 50-day moving average line. But it would make sense for it to just chill for a couple of days, kind of reset the deck, and then see if it can go higher. If we go back to the February waterfall effect, if we go back to the February waterfall, yesterday was what we called a follow-through, what Investor Business Daily calls a follow-through, and that's a minimum of 1.25%, a minimum up in volume above the prior day, a minimum of 4th day off the low. So definitely 4 days off the low, definitely a minimum up of 1.25%. In volume above the prior day. So everything constituted a follow-through day according to IBD. So now it's just looking at these, and we're going to look at some of the past corrections, and during corrections, you can make a little bit of money, but I highly recommend really kind of selling into strength, after you get that first leg down, because you get that first leg down, get a rally, you get that follow-through day. It was either right here or right here, kind of settled for a couple days, popped, and then just started to really struggle. I think that could happen here as well, just because typically when you have a sell-off like this, it's not immediately settled in a couple weeks or a month. But we are entering a seasonal bullish period of the year, so we got to buy, according to the follow-through day, you got to buy signal, so you're just going to kind of wait and see this out. But if history shows us anything, which we're going to look at the past corrections, you can get some false signals and some corrections. So I just want to kind of let you know that and keep that in mind. So if we do look at the Nasdaq, look at the weekly reversal chart, right? This is the weekly chart on the Nasdaq. It reversed and it's punching through long-term moving averages. This is all positive. But look at the Nasdaq, and this is very interesting. Let me go so if you see the waterfall back in January, the Nasdaq went all the way up to an all-time high. So these rallies, they can go a lot further than you think versus just finding resistance at the 50-day. They can really go up there, and this one surprised me because this was just sucking everybody back into the market until it got slammed down for another 10% correction. So, you just want to be cautious, but you want to play them, right? And that's just what you got to do. You get a signal, you take it. So, we'll just kind of keep this in mind. The Nasdaq was stronger. I noticed some of the FANG stocks were stronger yesterday. If we look at the daily chart, because you can see right here, this correction rally went all the way up and hit a new high. So now you're like, okay, correction's over because it made it, and then it just got slammed back down. So it's just important to really keep in mind that you need to have a plan in place. And if you haven't watched my moving averages webinar that I've been sending out over the last couple of weeks, whether the trading system is for you or not, I think there are some very, very good rules in there that you can use to make sure that if you're getting caught up here, you're not letting it roll all the way back down. You have a plan, you move to the side, you let it happen, you wait for another setup, okay? So right now we're right here. Resistance could be right here. We'll kind of see how it acts, but I think this 20-day moving average, the fact that it punched through, that's positive. That's showing me that we could get a rally. So I'm liking what I'm seeing, but the breadth is not necessarily matching it. Let's go to look at the past corrections first, and you might be getting annoyed about looking at past corrections, but man, this is how you learn. So, looking at the 2010 correction, you had a couple fall through days, right? You had a fall through day. I think this is a fall through day. And then it rolled over. And then you probably had another one somewhere in here and it failed, and then boom, third one's the charm, and then it just runs. So what's going to happen is during corrections, you're going to get whipsawed and you're going to get buy signals, and then you're immediately going to have to turn around and sell it maybe for a small loss, and that's just part of the game, right? But after that second time, maybe even that third time of just wearing your butt out, you are going to get the trend that will make your year. So the important thing is to just keep in mind of what is possible, and that way when you see something that is recognizable, that you've seen it before in past corrections, you know how to act. There are markets some markets are favorable. Markets go up, markets go down, markets go sideways. You just want to be in the markets that are going up, right? Sit out all the rest of the noise. So you just kind of keep that in mind. You got a couple false signals in here, and then you get a working one, or this might have been the right one, and then boom, you just get that rally where your stocks could potentially double coming out of this correction. So if we look at the 2011 correction, right, this again is going to wear you out one of these days. Let me kind of inspect this right here. That's not one. That might be a follow through day. I don't see how big it is up, but either way, you get these signals, and you're just kind of waiting, and you're just waiting, and you get it, and then it just kind of rolls back over again. The market it's going to be up a lot when these correction rallies. They're going to go up big and they're going to go up fast, and if you're sitting on the sideline, it's going to suck. So it's all about putting the odds in your favor, and you can see you probably got a signal somewhere up here, and then just boom, shakeout, and then another shakeout, and then you get that trend that again will make your year. So when you're in the beginning stages of a correction, and I think we are, when you get these rallies, I do believe that you want to have that trading plan where you are selling in a strength, you're raising your stop to break even, you're trailing the stops with your stock, and taking some profits into it. That way, if history tells us it does take that second leg, you're prepared. You made a little bit of money, maybe even you break even, but you know what? I'll take a break even if the market's getting slaughtered 10%. That's a 10% outperformance right there. I don't care how I get my outperformance. I'll get my outperformance sitting in cash. I prefer to get my outperformance on the upside. But you look at all these scenarios that get played throughout the year, and you can outperform the market by just knowing that the market's starting to crack and roll over. You look right here, the market, consolidated, and it immediately failed and cracked wide open right here. on this bar, there should have been some signs that the market, it could not break to an all-time high. It sliced through a major moving average. You should have been taking some profits right here, and then look what happened. You get a major waterfall going. So it's just, again, what, how the odds are going to be put in your favor. This right here was a major rally. I remember right here, I do remember this, and I remember there was a false signal in here, shakeout, another signal. That's a really good tradable rally. There was money made on this, and then it started to consolidate. You thought you were good, and then it just got weaker and weaker, and then boom. So you have like two double bottoms in this. You got one large double bottom, and then you got a double bottom here, rolled over, double bottom here. Boom, you get your signal, and then just the market goes in rally mode. When you are in these corrections, it will try to shake you out as much as possible. That is why it is important to have objective rules that you have in place, no matter what scenario happens, right? And you place your order, you walk away, you forget about it until you get that signal. And I think that's very important to be rules-based and be objective no matter what style of trader you are. Have your trading plan in place before your week starts, before your day starts. That's why I like to do so much research on the weekend, because all that noise of the market movements, it just doesn't affect me when I can see a settled chart and I say, okay, this looks right, this doesn't look right. But again, failed signal worked. Probably lost some money right here. Failed signal worked. Major rally. And then 2016, it was a major rally year. 2017 was solid. So the market's not going to make it easy for you, and it's not going to go straight up. I do want to look at, let's look at the VIX right now, because I think this is important. This is the fear gauge. The VIX made a lower low yesterday. That is a positive. It's getting out of this 20 zone. If you've been following me a while, you've seen I've done webinars, and that 20 level on the VIX is very important. But what, according to my research, that first spike above 20, typically there's another spike coming. So when this first spike came, I said, okay, let's just be cautious. And then we got another spike, right? It came down and then got another spike, the shakeout. And now it's starting to get back down where, the market seems like it's wanting to rally. So just, this to me is a positive sign. We'll keep our eye on this, because, you had the spikes up here, it went back down, and then it immediately reversed. Now, again, I don't make trading decisions with the VIX, but it's just that evidence, right, that I'm looking at. And again, I want to repeat that. According to my studies, that if you ever get a spike in the VIX above 20, the odds are that is not the first spike. There's going to be, a suck you back in type of bounce, and then you're going to get another spike back above 20. So typically after that second spike, it's going to give you a little bit more confidence to step into the trade, because you already had a shakeout. I love setups where you've already been shaken out once, because the weak holders are already ticked off. They don't want anything to do with it. And that's when the institutions are going to push up the stock, right? The market makers already push you out. So, but sometimes you're going to have 2 or 3 shakeouts. If I see a stock I really love and it's already, had 3 failed breakouts, but that next one is setting up so perfectly, the likelihood of me taking that are incredibly high, because I know it's already failed multiple times and it is just wearing the weak holders out. And that's typically what happens. The market's going to wear you out, then boom, make its big move. So kind of keep that in mind. Excuse me. So, back to kind of the double dips, I just wanted to show you the past 3 corrections, looking at the RSI 5 on the S&P 500 weekly chart. You have taken a double dip in the RSI when you've been in correction mode. You can see in 2010 and 2011, 2016. We haven't taken that double dip yet, right? We just took that first leg once we entered the oversold zone. So keep in mind history. That's why I'm saying, hey, you know, maybe it does make sense for you to make sure that, you know, if you're selling in a strength or if the market starts to crack, that you move out of the way and move out of the way quickly, because history is telling us that it just needs more time. It needs more time to digest. So the percent of stocks above the 200-day moving average in the S&P are almost back out of correction mode. That happened right here and it immediately rolled back in. But if it, you know, is staying above 60, that's bullish, right? Because it can't always be 80 and 90. Sometimes it's just, you know, the market's kind of chugging along. It's not really bad. It's not really good. But it's trying to get out of this correction mode. You can see all of a sudden now 80% of the stocks are above the 20-day moving average. So you kind of have a quick, you know, bounce off the bottom. Hopefully this holds for a while, and I'm really hoping that this rally works. At least gets up a little bit, gets close to an all-time high. We'll really keep our eye on it. However, when you look at the high-low breadth, you know, it's a breadth indicator. It does not look as rosy, because you can see on this correction right here, man, you had a major breadth thrust to the downside and not a breadth thrust back up to the upside. So lots of distribution, not a lot of accumulation, right? Not a lot of participation. Man, that's a lot of red, very, very little black. Not what you want to see. That is kind of one of those things behind the scene that's making me just a little bit suspect. Always focus on the price and volume first, but that doesn't mean I'm going to ignore some of the evidence behind the scene. Doesn't mean we can't rally. Doesn't mean I'm going to ignore some of the evidence, but this is just important to know. I do want to look at China real quick because it's very interesting. You know, it broke below a 3-year trend line, a horizontal trend line, and it's really struggling right now. And it came off the bottom and kind of created a little mini consolidation. You can see right here, but now it's rolling back over. I don't really want to see emerging markets in China just get crushed because, you know, eventually that could spill over. Now, if we look down here, there's really no correlation whatsoever between the Chinese market and the U.S. market. A lot of people think there is, but this right here, this is a correlation chart. It's either totally correlated or non-correlated. So, I mean, it just goes to show you that they don't really move together. So if this cracks, it doesn't mean the U.S. is going to crack, but, you know, this is the second biggest economy, so you want it to, or it is one of the fastest growing economies, so you want it to be strong, and it's not. Okay, I'm taking sips of coffee in case you were wondering. So the S&P 500, you know, 80% above the 20-day EMA. This is a short-term breadth indicator. Technology is back, baby, 81%. Financials, 80. Discretionary, XLY is discretionary, 80. Industrial, healthcare, we're going to take a look at that. Staples is not quite 80, so it's good. The defensive is starting to get a little weaker. Energy is it hasn't really participated in the rally in the last off the bottom. So that's just kind of one to show you that energy has been the weakest, at least in the last couple weeks. Materials have been strong. Utilities are still way up there. Utilities are up there. So we're going to take a look at that here in a minute. We're going to take a look at the sector summary really right here. Okay, so yesterday technology and healthcare were towards the top. That is solid. That is exactly what you want to see with discretionary up there. So on that follow through day, you have some of the most aggressive sectors up. Positive, right? You have real estate, utility, staples towards the bottom. Also positive. So you have the strongest sectors towards the top, the most defensive sectors toward the bottom. I like it. Let's see what's happened in the last 1 month. You can see that staples, it's flipped in the last 1 month. Well, it makes sense because of the sell-off. The most defensive sectors are towards the top. energy has just not done well in the last month. So, you know, it's probably a pretty ugly looking chart. Now it's bouncing off the bottom, but that's one heck of a waterfall. I mean, again, it just kind of shows me that it's one of the weaker ones. Let's see what's happened last week. Materials are all of a sudden starting to shine a little bit this week. Maybe we can have a look at that to see what... That's pretty broad participation right there. You have steel, chemicals, commodities, paper. Mining is actually the weakest. So when you think of materials, typically I think of mining. But that's actually the weakest. So you want to be in the strongest industry, in the strongest sector. And this week, as far as money has flown into utility or steel, and you can see right here, and maybe this has to do with some steel tariffs and all that good mumbo jumbo stuff, but it's looking kind of interesting right now. Steel is one to watch. It kind of makes me want to go out there and what is that ETF? I'll just type in steel, see if I can get there we go. The steel ETF. Yeah, so it is still in a downtrend. The SLX is still in a downtrend. It's strong off the bottom, but I mean, this is, you know, just every time it makes a new low. So for me to get involved in something like steel, even though it's had a good week, I'm looking for a consolidation and then a higher high, right? I'm looking for that breakout of a base, and here's one right here, and it failed, and since then you really haven't had one. It's just grinding its way down 50 days under the 200 days, so not for me. The chemicals, let me see if I can look at this chart a little bit. Holy crap, that is interesting. The U.S. specialty chemicals, there's something going on here. This is more than just a bounce off the bottom. This is extended, so I would look for a retracement. I'm gonna write that down because I'm kind of doing this on the fly. Chemicals are looking like a strong sector, so you might want to look at a retracement in that industry. Commodity chemicals, excuse me, bounce off the bottom, but not near as strong as specialty chemicals. So, you know, materials are looking rather interesting. Let's go to the complete industry summary. And again, the industry, a sector is made up of industries. So you want the strongest stocks and the strongest industries and the strongest sectors. So let's just go look at the last week. Okay. Let's see what stands out. Like, what is up the most? Durable household products. I'm just going to see what kind of stocks those are. iRobot, so you got some technology. Whirlpool, okay, I get it. Broad participation. This Newell Brands is the strongest. iRobot has definitely bounced back. I'm familiar with that stock. It hasn't created a consolidation. Sometimes it's tough when you're investing in these V-shaped consolidations. A lot of times you're going to get shaken out, so I would wait for the shakeout on something like that. But durable household products might be a honey hole to fish in. So let's continue our fishing trip. Consumer staples, not exciting. Renewables, it's up there, but it's not the most. Insurance, it's up there. It's a lot of 7%. Heavy construction, commercial vehicles. Let's click on that. Heavy construction up 10% this week. Man, that's a lot of buying power, and that is broad participation right there. So that's what I look at. I want to make sure that the individual industry is not just being moved by one mega stock. This is looking incredibly interesting. Something that's up. I'm not familiar with this. I'm sure this probably is an earnings gap right here. Great Lakes Dredge and Dock. I'm not familiar with this company. But that's one hell of a skyscraper right there. You might want to, play this gap fill right here. It might not be a bad idea. IBP, I've heard of this company at least. Man, that's one heck of a downtrend. Let's see if I can look at the weekly chart on this, see if I can get something pretty. Well, it's not really prettier, but it did complete a weekly reversal pattern. You can see right here, IBP And there's a lot of money flowing into this. Man, that looks ugly. From 79 to 29, that's a $50 loss. So have your rules in place. Always, always, always have your rules in place. Make sure you're not sitting through something like that. So you have a lot of heavy construction looking pretty interesting. Kind of go back to the 1 week. Okay, so far we got durable household goods. We have, okay, and then let's kind of continue to go down. Heavy construction. Healthcare has been strong. It hasn't really bounced back as strong this week, but healthcare has been incredibly strong. We already looked at the steel stocks. Might be something to consider. And then kind of, and again, I'm just scanning this percentage gain right here to see like what is up the most. I'd say, technology was up the most yesterday, but, if we were to just kind of go yesterday, let's go end of day. So just to see, retailers was up big yesterday, 5%, renewables, healthcare. Okay, healthcare providers. I mean, that's a lot, So healthcare was up a lot today. Big day in healthcare. You can see there's broad participation. Even the weakest one was up more than the S&P 500. That's kind of really standing out to me. So when you have when the market has a really good day, then you look at a broad participation. I do have a bias towards healthcare right now because it was the strongest chart in the most recent uptrend before the market rolled over. So again, looking at healthcare, healthcare providers have just been incredibly strong. Let's look at kind of the last 1 month. You can just see kind of go down here. And by the way, these tools on stock charts, the tool I'm going through at least is free. So you might want to have a look-see at this, but that's some broad participation right there. Let's just kind of look at this. This doesn't really show much of a correction. It did correct and then it reversed, and then just look at all this money piling in to NEO. Now this is already quite tripled almost, but man, that's a strong stock. With that kind of accumulation, it might need to consolidate, but that's just now piling in. So big money is going into NEO. Let's look at the one on top. Let's look at the last week. Health management systems. Look at all this money piling in to health management systems. Is just kind of trading tight. Broke out. I'm sure that's an earnings gap. That one's probably earnings too. But it has a history, so you just might want to consolidate and wait for the breakout. So, as far as honey holes to fish in, if we go back to really go back to the industries and really just look at the last week, I do think healthcare, it was looking pretty strong yesterday, so I think you want to fish there. Heavy construction, all of a sudden there's money flowing into heavy construction stocks. And then what was the other one we found in discretion? Was it in discretionary? Communication, staples, energy, reinsurance. I can't remember the other one. Steel was one. Real estate, technology. Oh, where was it? Let's look at the last month. Automobiles have been strong. Okay, that was it. Non-durable household products in the last month has been strong within consumer staples. But non-durable household products sometimes more have a discretionary as well. But that has been incredibly strong. So take a look there. If you have any questions, let me know. Just kind of one quick announcement. Give me just a second if you're still with me. I did recently launch my ETF QQQ trading system. It more is a relaunch. I've been working on it for several years. If you have any questions about it, just email me. I sent an email out earlier last night and today, just offering my calendar space. I want to make sure if you are unsure that if this product is for you, that you have an opportunity to ask me questions. So send me an email, book a time on my calendar. You can book a 30-minute slot and we can chat about this. So, watch this presentation that I've been sending out if you haven't already. Even if it's not for you, there are some really, really good rules that I teach in this presentation on how to use moving averages, which I think is incredibly relevant in today's type of market. So there's some really good nuggets that you can take away and some really good rules that you can write down. So watch this, and then I'll walk you through my trading system. And if you still have additional questions, just reach out to me and book a time. So I hope all is well. Let me know if you have any questions.